Hey, good morning. Give me a thumbs up if you can hear me. And now, if my voice is audible, I hope you enjoyed the music and I hope you all are ready to get started. We'll just wait till the clock ticks over to 12 p.m. and then we will go. And as the clock has ticked over to 12 p.m., let's start. Good morning, everybody. I hope you all are having a fabulous Sunday. My name is Kushal Bhagi, and welcome to Market Masters Active and Passive Investing. What is Market Master, you might be asking? Market Master is actually a very recent series and initiative that we have started at ET Money. It is essentially a very brief learning program targeted at the do it yourself investor, which all of you are. I mean, anybody who's using an online or digital platform is a do it yourself investor. And active and passive investing is a part of one of the presentations, but we thought we'll bring it out and we'll try and come on YouTube as well and maybe reach out to a wider audience. So, firstly, thank you everybody for coming over here. And I think in around 45, 50 minutes, if I go up another 5 minutes, my apologies in advance. All right. A little bit about myself. My name is Kushal, and I have a fair amount of experience in financial services and education, primarily in the mutual fund space. I'm not an employee of ET Money as yet. All right. I actually consult with them. I manage investments of HNI and ultra HNI clients. I manage help them with their mutual fund investments. But I am seriously passionate about investor awareness. And when ET Money saw the kind of work that I was doing and the impact that it was having on my limited group, I'm not very good at marketing myself. They came and said, hey, why don't you come over and talk to our people, talk to our users, and maybe, they can benefit from that. So I run these webinars for them, and the webinars that I run are very, very different. It's very simple, very, very non-technical in nature. All right, very non-technical in nature, because I think that webinars should be there for people to really understand and absorb what it is that I am speaking about. I promise you an insightful webinar and certainly actionable. When I say actionable, means after the webinar, there should be some sort of action that you should be directed to take. Obviously, the choice whether you take it or not is yours. The style is very, very free flowing. All right. So, what I'm going to request you to do is sit back. Don't ask out of questions, out of context questions in the chat. Vijay, etc. I promise I will answer as many questions as I can at the end of this presentation. But allow me and give me the opportunity to guide your thinking, give me the opportunity to guide your thought processes, because I want this session to be a little thought provoking. And it's great, no? All you have to do is sit back and sort of enjoy. So I'll keep asking you to give me thumbs ups and keep giving me some feedback in the comments. This is YouTube, so there can be a little bit of lag in terms of when I'm speaking and when you are able to actually hear it. So support me by keep on giving me feedback. And like I said, this is going to be an actionable presentation, and the main action or the main point that we are going to focus on today is, should passive funds occupy part of your core portfolio going forward? All right, I think if you're able to address this, then I think this is going to be really, really cool. All your questions, guys, put it towards the end of the presentation, because then I won't have to scroll so far up to see it. I'm not going to answer any questions like this in the beginning. All right, so help me to help you, and let's get started. All right, one of the hottest topics in investing today, especially in this country, is the debate versus active versus passive. Should you have active funds of your portfolio? Should you have more passive funds on your portfolio? Why is there all this sudden interest in passive investing? Well, when we're going to get started, let's get started with the very basics. And the basics are, what is a high level difference between active and passive? And what I've done is I've created certain themes, and we are going to talk about how this is different across all these themes. So, firstly, from a purpose point of view, what is the purpose of an active fund? Maybe I should just put my camera off so that you will be able to see the slides a little better. Is that better? I'll keep coming back and keep looking at seeing you. All right. So, the purpose of an active fund is, you're going to construct a portfolio. You're going to buy and sell securities. You're going to decide which securities should form part of that portfolio. And the purpose of creating a portfolio where you or the fund manager are choosing the securities is that you are going to beat, or that portfolio is going to beat, the benchmark. Okay. The purpose of all active funds is to be able to beat their benchmark. The benchmark is a similar index. So if you are looking at a large cap active fund, you are going to beat an index like the Nifty 50 or the Nifty 100. If you're constructing a mid cap fund that is active, you're going to be looking at beating a mid cap index. A passive fund, as the name suggests, is passive. There is not much work that the fund manager has to do. There is no active selection that is happening of stocks and securities. The only job is to mimic or track the performance of the index. So if in the Nifty 50 you have got 50 stocks and each of those 50 stocks have different weightages, then the purpose of a passive fund is to create or to copy the same index, have the same 50 securities, and keep them in the same percentages as the index. So essentially, it is giving you an opportunity to go and buy the index itself. All right. If that is the case, then no doubt from a fund management perspective, in an active fund, it's going to be a fairly top heavy fund management team, right? You're going to get analysts, many researchers, many sector specialists. There are so many funds that are there in the mutual fund industry today. It's almost as if each fund has a certain core team of fund managers that are looking at how to manage that fund. But in a passive fund, again, as the name suggests, the role of a fund manager is extremely limited because, like I said, you're just copying or mimicking the index. From a cost perspective, it's fairly easy to understand that a active fund is going to be more costlier because there are going to be many teams. You're going to have to pay a lot of people, right? The fund manager team is quite big, so it is going to be a cost because you have to pay their salaries. Whereas in passive, if the fund manager's role is fairly limited, then the costs are also minimal. From a marketability perspective, wherever there are higher margins, there are more incentives that can be give to push those funds. So in active funds, because the costs are higher and therefore the margins are higher, you can load up on them, and therefore there is incentives for the middleman to go and sell. So it becomes more marketable to sell an active fund. In a passive fund, as the name suggests, because it is passive, the costs are also lower. And if it is a low margin product, there are obviously lesser sales incentives, right? So passive fund ka wahi hai yaar, that it is a low cost product, right? It is a low cost product. So then you would say, why would there be not be more interest in passive funds if it's a low cost product? What is the allure of active funds? And the main allure of active funds is this, that it is possible to achieve better than market returns. Do you agree with me? How many of us want the best performing funds as part of our portfolio? Market has given 12%. Don't you want that one fund that is given 16% or 17%, for example? That is the allure. That is why people want to go in for active, because there is a possibility to generate significantly higher returns than the benchmark. But it's also the opposite, because you are trying to beat the benchmark. If you're successful, that's great. But if you're not, you can learn that earning, you can fall short of the benchmark as well. Okay. In a passive fund, you are going to be able to earn market returns at best. You're not going to be able to beat the benchmark returns. At best, you are going to be able to match the benchmark returns, because that is the purpose of a passive fund. The allure of a passive fund is, say, listen, don't want to take any of this fund manager risk because I don't know which fund manager or which fund is going to beat the market or not. So I'm happy with market returns. I'm happy as keeping my low cost, because if I'm looking to create wealth through mutual funds, which is the purpose of equity mutual funds in the first place, I might as well save on costs, because as we all understand, over a period of 15 years, 20 years, 25 years, even 1% difference can make a big difference on the overall amount of your earnings. From a variety perspective, and give me a thumbs up, everybody, if we're sort of got the basic high level difference between an active passive. As far as a variety is concerned, there is absolutely no problem. Both on active and passive funds, there is so much to choose from. I wish I had the money personally to invest in all the options that were out there and available to us. All right. So that is active versus passive. And when we move further, a lot of people have this question, right? Index fund kya hai? ETF fund kya hai? Is it basically the same? Right. And again, I'm here to give you a very non-technical but very practical view of this entire thing, that I believe index funds and ETFs is same but not same. It's like two sides of a coin. All right. Let me focus on some of the similarities first. Basically, from an objective perspective, both an index fund and an ETF are trying to track a benchmark or an index. So let us say an index like the Nifty 50. You will have an index fund that is trying to track a Nifty 50, and an ETF, which is an exchange traded fund, is also going to be able to track the same Nifty 50. So the purpose of both is pretty much the same. from a cost perspective. And this is something that people really love to dissect. I really don't understand why, because both of these are low cost options. Now you are trying to figure out which is the lower cost option of the lower cost options. I think the other things in life to sort of focus on. So just understand that index fund is a low cost option. ETF is also a low cost option because they are both from the passive category, right? So passive funds by definition are going to be low cost. So what is the difference then? The difference is that an index fund is essentially exactly like going and buying into a mutual fund scheme. Just like you would buy a blue chip fund or a mid cap fund from various AMCs, you can actually go and buy an index fund, whether it's the Nifty 50 or the Nifty 100 or the Nifty Next 50. You can go and buy it exactly like a mutual fund scheme for an exchange traded fund. As the name suggests, it's traded on the exchange. So the buying process is very similar, if not the same, as how you would go and buy shares. All right. So again, if you're looking at buying an index fund and if you're saying the process is the same as a mutual fund, then mutual fund maybe all get end of day NAV, right? And T plus one, T minus one, etc. It's the same thing with index funds. And as ETFs is the process the same as buying shares, you can buy ETFs during market hours at market prices. Right. So index fund you will get after the market closes. ETF you will be able to go and buy or sell during market hours. Because the mutual fund and index fund is the same sort of category, you don't need a demat account. It's not compulsory for index funds. Okay. But if you are going to buy ETFs, again, if you're going to buy shares, then you need a trading and demat account, right? So that is compulsory for an ETF perspective. I believe from an SIP perspective, how many of you are SIP investors? Type a yes, SIP, etc. in the chat box and show me some feedback. If you're an SIP investor, I think that's perfect for index funds. It's very easy because like I said, it's just like going and buying another mutual fund or starting an SIP in a mutual fund. You want to do a 5,000 rupee SIP in an index fund, you want to do a 500,000 rupee SIP in an index fund, that can be done. When you look at ETFs, you're generally not buying it in rupees, you are buying it in number of units. So what will happen, it becomes a little awkward, right, to go and set up a SIP, because it's like saying you're going to set up an SIP for a number of units but not for rupees, because the rupee amount is going to keep changing since you can only go and buy it in units. And finally, the one difference is from a liquidity perspective. In an index funds, there is no problem with respect to liquidity because the AMC has to create the units and give it to you. But an ETF, like I said, you're going and buying it like just another share. Liquidity becomes a problem. For some ETFs, there might not be enough buyers and sellers in the market. And if there aren't enough buyers and sellers in the market, you're not going to get the right price, whether you want to buy or when you want to sell your ETF. So if you want to go and buy and you want to invest big amounts, especially in the ETF space, a good hygiene check would be to check the liquidity of that particular ETF. So, out of all of this, what is it that you really need to understand, right? Or what is it that you really need to take home? I think the two things are A, from a similarity perspective, the purpose of both an index fund and ETF is really the same. They are both low cost options that are looking to go and track a benchmark or a particular index. And the other thing that you need to take away is that if you are an SIP investor, then index funds over ETFs, I think, would be the right way to go. All right. What about variety? I told you index funds may, and active funds, we already know the variety, right? There are so many funds and they just keep coming. They just keep coming. It's a problem that we have. It's a problem of choice that we have, right? As far as active funds are concerned. Um, Nanaji, I'll try to speak a little bit in Hindi, but this will be largely an English presentation. Okay. I'll try to speak a little bit in Hindi from time to time. I hope that's okay. From a market cap weighted index. Market cap weighted का मतलब क्या होता है? It is like the Nifty 50, Nifty 100. These are market cap weighted indices. Market cap weighted matlab all the constituents of that particular index based on their size have a certain weightage in their portfolio. So in the Nifty 50, for example, Reliance will have a much larger weightage than Nestle, which will have a much lesser weightage. These are the most popular types of index funds and ETFs, not only in India, but around the world. All right. You can also look at sectoral और theme based ETFs. अगर आपको फार्मा इंडस्ट्री में इन्वेस्ट करना है या ऑटो इंडस्ट्री में इन्वेस्ट करना है, अगर आपको बैंक्स में डालना है बट सिर्फ प्राइवेट बैंक्स में डालना है, राइट, ऑल दीज काइंड ऑफ ऑप्शंस बेस्ड ऑन सेक्टर्स, बेस्ड ऑन थीम्स आर अवेलेबल टू अस. ओके. कमोडिटीज, अगर आपको गोल्ड और सिल्वर में इन्वेस्ट करना है और आपको फिजिकल गोल्ड नहीं लेना है, इफ यू वांट टू बाय डिजिटल गोल्ड, इफ यू वांट टू बाय एक्सचेंज ट्रेडेड गोल्ड, यू कैन बाय इट. Obviously storage ka problem is not there, so it's another way, and it's sort of taking off, where you can actually buy index funds and ETFs of gold and silver. अगर आपको इंटरनेशनल मार्केट्स में इन्वेस्ट करना है, यू वांट टू इन्वेस्ट इन ग्लोबल मार्केट्स, यू वांट टू इन्वेस्ट इन स्पेसिफिक मार्केट्स, राइट, whether it's the Nasdaq or the S&P in the US, all these options are now हमारे अपने पास अवेलेबल है. Okay. Factor and smart beta, as somebody has mentioned. You know what factor and smart beta investing, again, ये मतलब आपको variety दे रहा है, right? This factor and smart beta, ये क्या बोल रहा है? We will identify based on data and certain trends, certain factors, और ये factors के भरोसे पे हम लोग portfolio बना देंगे. So for example, you see the first one, which is Nifty 50 equal weight. How is it different? Nifty 50 market cap weighted, मतलब 50 stocks are there, all the 50 stocks के पास अलग weightage है size के ऊपर से. Over here आप क्या बोल रहे हैं? You're saying we'll make a portfolio या 50 stocks जो है सबको 2% weightage देते हैं, तो ये आपका एक नया portfolio. और यू आर सेइंग वी विल आइडेंटिफाई द टॉप 100 कंपनीज, और वो 100 कंपनीज में जो 50 कंपनी के वॉलेटिलिटी सब लेस है, विच एवर एज द 50 लीस्ट वॉलेटाइल स्टॉक्स, उसका पोर्टफोलियो बना दे सकते हैं आपको, और विच एवर वन हैज द हायर बीटा. सो एसेंशियली व्हाट दे आर डूइंग इज दे आर जस्ट कार्विंग आउट एवरीथिंग एंड गिविंग यू ऑल दीज काइंड्स ऑफ वैरायटीज. एंड यस, देयर आर ETFs and index funds that invest in debt instruments as well. Give me a thumbs up, give me an okay if all of us are familiar now, saying variety is the spice of life, and there is enough variety in the passive space, and this is only going to get more and more and more and more. All right. If I were you, I would focus only on market cap weighted index funds and ETFs. And even from an ETF perspective, when we talk about liquidity, I would say a Nifty 50 fund may, so there's ample liquidity. You don't really need to worry about that at all, because market cap weighted are the most popular type of ETFs in India and the world. Okay, we're going to dive into the next part of the presentation now that we've got our basics in order. And you're seeing that in India, active funds ke paas 90% market share hai. 90% market share. It sounds very big. If passive is only 10%, why are we having this big conversation? Why do active funds have a 90% market share? And iska bada simple sa sawal hai that availability yahi thi. Right, the industry opened up to private sectors in the mid 90s. वो time पे active funds ही available थे market में. The first sort of ETF came in the maybe the early 2000s, but वो ठीक से चला नहीं. Right, it didn't really capture the interest and imagination of people. ETFs has only become popular now, so by and large it has only been active funds that have been available. And वो जमाने में, people did not understand mutual funds क्या होते हैं, etc. People had to be sold the concept of mutual fund. People had to be really made aware of the concept of mutual funds. So if that was the case, then the middleman, जो distributor था, they certainly needed to be incentivized, to go and build the market. Sale करना इतना आसान नहीं था. आपको पकड़ना है, आपको समझाना है, आपको 2 बार समझाना है, 3 बार समझाना है, विजिट करना है, फेस टू फेस करना है. You are parting with your money at the end of it. Passive funds में there is no commission only inbuilt into it, because it's a low cost product. So active funds have almost been there from the very, very start. The purpose of active funds is to beat the benchmark, right? And a lot of fund managers were able to do that. They were able to give you that performance. And जैसे होता है ना, in cricket we have our heroes, in Bollywood we have our heroes. ये म्यूचुअल फंड इंडस्ट्री में फंड मैनेजर्स बिकेम हीरोज, ये तो भगवान सम्मानित हो गए, बिकॉज दे वर एक्चुअली गोइंग एंड क्रिएटिंग मनी फॉर अस. दैट इज व्हाई एक्टिव फंड्स हैव बीन वेरी वेरी पॉपुलर इन इंडिया. सो द क्वेश्चन इज, अगर एक्टिव फंड्स हैज बीन वेरी पॉपुलर इन इंडिया, देन व्हाई ऑल ऑफ अ सडन आर वी टॉकिंग अबाउट passive investing so much, right? And I think there are 3 reasons or 3 or 4 reasons why, and I'm going to dive in and explain that to you. Give me a thumbs up if you all are all on the same page, because this is that free flowing sort of presentation. So I'm going to take your thinking and make it go up stepwise, stepwise, stepwise. So if you are able to visualize what it is I'm talking about, तो मेरे को एक thumbs up दे दो, then I know that I am being able to reach out to all of you. ओके, फैंटास्टिक, थैंक यू वेरी मच. तो ये पैसिव इंटरेस्टिंग में इतना क्यों? ओके। um, पहले आपको ये देखना है, वन रीजन इज व्हाट आई कॉल परफॉर्मेंस रिप्रेजेंटेशन. When a mutual fund, when a stock, when a security आपको returns दे रही है, there are two types of returns that you can see. Number one is called price returns. Okay, price return is the price appreciation of the portfolio of the security. So if the price has moved from 100 to 120, it means the price appreciation has been 20%. But there is also called a concept called total returns. And total returns का मतलब it is not only the price that has gone from 100 to 120, but अगर वो portfolio में थोड़े the stocks जो है वो dividend भी देते हैं, तो that dividend is not counted in the price. वो dividend भी add होने चाहिए ना. और अगर आप सिर्फ निफ्टी के बारे में बता दो, सिर्फ निफ्टी के बारे में सोच लो, निफ्टी पे द डिविडेंड वर्क्स आउट टू बी अराउंड 1% per annum. Okay, 1% per annum. So to make it clear, Nifty 50 is measuring something called price returns. Okay, Nifty 50 is measuring something called price return. Nifty 50 TRI, TRI matlab total return index, measures the actual returns, which are the total returns, which is price plus the dividend earned on your securities. Now, this is what used to happen. And tell me if you think this is right or this is wrong. Maybe we can have a quick debate over that. When active funds used to publish apna performance against the benchmark, because all active funds, like we said, are have to beat that particular benchmark. तो जब वो उनका परफॉर्मेंस पब्लिश किया करते थे, they would use the total returns that their fund has delivered, which is the right thing to do. Okay, लेकिन जब वो बेंचमार्क का परफॉर्मेंस पब्लिश करते थे, वहां सिर्फ प्राइस रिटर्न्स यूज होता था. द टोटल रिटर्न्स वुड नॉट बी यूज्ड. इज दैट अ करेक्ट थिंग और इज दैट अ रॉन्ग थिंग? एंड एज मोस्ट ऑफ यू माइट अंडरस्टैंड, दैट्स प्रोबेबली नॉट करेक्ट, नो. बिकॉज अगर आप अपना रिटर्न दिखा रहे हैं एज टोटल रिटर्न, देन बेंचमार्क का रिटर्न भी आपको दिखाना पड़ता है कि टोटल रिटर्न, एंड दिस फॉर वट एवर रीजन वाज नॉट हैपनिंग. Okay. So in 2018, SEBI was making a lot of changes in the industry for increased transparency, etc. वहां उन्होंने बोला था कि यार, ये तो मतलब इट्स ऑलमोस्ट एज इफ आप अपना परफॉर्मेंस आर्टिफिशियली इन्फ्लेट कर रहे हो ना एक्टिव फंड्स का. बिकॉज इफ द निफ्टी, जस्ट इमेजिन निफ्टी का द डिफरेंस इन डिविडेंड इज अराउंड 1%, मतलब आप अपना 1% ज्यादा दिखा रहे हो, तो ये ठीक बात नहीं है. तो व्हाट दे सेड वाज, from 2018, जब भी, and upload, I'm sure you are all looking at fact sheets. When you look at a fact sheet now and you see the index over there, that the benchmark of the index, it is always Nifty 50, nahi, Nifty 50 TRI likha hota hai. The words TRI, or the letters rather TRI, have been added to that, which is called Total Returns Index. So it is a better representation now of performance, and that has been done since 2018, so in the last 4 years. Okay. One other thing that used to happen is the impact of something called recategorization or reclassification of schemes. Now, you will agree with me that the aim of an active fund is to beat the benchmark over the long term. वो हमने देख लिया है. All right. And as some of you all are also mentioning over here, कि apple to apple comparison तो होना जरूरी है, right? So if you are looking at a large cap fund, it has to be benchmarked against a large cap indices. Large cap indices मतलब Nifty 50, Nifty 100. These are the two most popular large cap indices. अगर आप small cap fund चला रहे हो, then you cannot benchmark it to the Nifty 50. Then you have to benchmark it to the small cap index only. मतलब it's fairly simple, right? It's fairly common sense, I would say. SEBI again spotted some instances where this was not working properly. For example, sometimes what used to happen is large cap fund, mutual fund is allowing a large cap scheme, okay, which means you should be investing in large cap companies. So you are comparing it to a Nifty 50, Nifty 100. लेकिन कभी कभी क्या होता था, if the fund management team saw an opportunity in the mid cap space or the small cap space, sometimes a larger part of their money or a substantial part of their money or a meaningful part of the money, they would go and buy into those mid cap, small cap. And again, SEBI said this is not very right, because agar investor ne diya paisa into investing into a large cap scheme, then you are almost violating the principle, no, by going and taking meaningful exposure in small cap, mid cap. Investor को अगर डालना है मिड कैप स्मॉल कैप में, तो वो खुद डाके डाले. आप क्यों ऐसे जाके कर रहे हो? So, what came out as a result of all these things, and again, SEBI is to be applauded for the work that they have done in order to increase transparency, there was a recategorization and reclassification of all its schemes. What SEBI did is they laid out various categories for various schemes. They said if your mutual fund wants to run a large cap scheme, then we will define the universe of what you can invest in, what you cannot invest in. So large cap may, they said the top 100 companies by market cap is going to be defined as the large cap space. Uske upar, they've gone and put a rule to say that 80% of the monies that you collect have to necessarily be invested in these top 100 companies. So the scope of going outside these top 100 companies was very, very limited, and therefore you are able to consistently have an apples to apples comparison. Does that make sense? If it does, tell me yes, yes, or give me a thumbs up. Similarly, they defined in the mid cap space, they said mid cap space is the next 150 companies, and 65% should be in this bucket. They defined the small cap space. Like this, there were some 15, 20 categories of mutual funds that were categorized, or subka, right? Subka definitions or universe defined kiya hua hai. In fact, now I think SEBI recently has gone and done one step further, where they have gone and defined the benchmarks also that you can use. तो ये नहीं कि a large cap fund, if there are 30 large cap funds in the industry, all 30 should be using the same or similar benchmarks. Then that is the way that we people who are looking to go and invest, who want to go and assess which is a good fund, what is the track record, we can do it in a more transparent manner. Okay. So this is one thing that again SEBI had done. As a result of this, you will see what has happened in the large cap space is, if you are saying the large cap universe is the top 100 companies and almost all your money has to be deployed in this top 100 companies, uh, the Nifty 50 also, right? Nifty 50 may, the 50 stocks are around 70% of the total stock market capitalization, right? It's almost wo 80-20 rule hai. Even if you look at the Nifty 100 as an index, it is that 20% of the companies will have 80% of the market share. So as a result, what started happening, and again, tell me if you agree with this or you are able to visualize this, is that everyone's portfolio started to look very similar in the large cap space. With 30 AMCs ke portfolio, all of a sudden, because all of them are holding the same kind of companies, no, the same number of companies also, maybe in different weightages, maybe in different percentages, but the same sort of companies are there in सबके portfolio में. So between a Birla, for example, or an HDFC or an ICICI Pru, for example, between the Nifty 50, Nifty 100, सबके portfolio same ही लिखने लगे. So all of a sudden, what you're saying is that the universe got very strictly defined. It became very hard to differentiate not just one front from the other, but one front from the index as well. Makes sense, right? Isn't it? Makes sense. So that's what started happening. In large cap space, mein, all the funds and the index started to look very, very similar. And finally, I'm going to talk, and let me show my face again because none of you all have very seen me, is the advent of online platforms. Online platforms, जैसे कि ET Money का online platform है, and some of the others that have also come up, they've taken advantage of the technology, the growth in technology. It's so easy to invest, no? I mean, अभी हाथ में फोन तो पहले वो फोन छोड़ते ही नहीं है. मतलब इन्वेस्ट करना इतना आसान हो गया, इतना आसान हो गया, it's unbelievable. And because of these online platforms, what has happened is costs have also started to come into focus. I'll tell you about active versus passive investing on costs a little in a little while. But one of the other reasons why costs have started to come into focus is because ये सब चिल्लाने लगे direct plan है, direct plan है, direct plan है. Right? Come invest with us. Direct plans are cheaper. Direct plans are commission free. Some of them say direct plans are free. Come invest. Direct plan, direct plan, direct plan. Somebody shouting at the top of their voice कि this is cheaper, this is cheaper, this is cheaper. तो हम लोग तो जाके देखेंगे कि ये cheaper का मतलब क्या होता है. And over here, what I've done is I've just created a little illustration for you. This is a scheme category, so large cap and mid cap fund. From 2013, 1st Jan 2013, SEBI again mandated that all mutual fund schemes must necessarily have a regular plan and a direct plan of the same scheme. इसमें फ़र्क क्या है रेगुलर प्लान एंड डायरेक्ट प्लान में? वेल, लार्जली देयर इज़ नो डिफरेंस, ओके? द फंड मैनेजर इज़ द सेम, पोर्टफोलियो भी सेम रहता है, स्ट्रैटेजी भी सेम रहती है. It is exactly the same. The only difference is what you will see on the right hand column is something called expense ratio. Okay, what is expense ratio? And you can see that regular plan ka expense ratio is higher than the direct plan ka expense ratio. Expense ratio is essentially saying that mutual fund भी एक धंधा होता है, right? Mutual fund is also a dhanda. They also have costs. They also have to run the business. They also have to pay fees, rent, operational expenses, audit fees, transaction, all these kinds of fees they have to run, no, to provide you that service. So they are charging you. I'll show you how they charge you in a moment. But basically, they are charging you the fees. So regular plan may, it includes the commission that is paid out to the middleman, right? Now, most of this while, all this while until basically online platforms came on, people have always invested through middlemen. People have always invested through distributors. Okay. And that distributor has helped the investor to get started, to select funds, to review funds. मतलब एक साथी होता है. And that was the distributor, and they used to get paid. I'll show you how they get paid again. But now direct plans may you are bypassing the distributor. So you are saving on that commission. That is why regular plan pay expense ratio zyada hota hai. I'm going to hide my face again and show the screen now. And direct plan mein the expense ratios are lesser. Okay. Now what I am going to go and do is I'm going to show you how this expense ratio is levied on people, because हम लोग जब समझो 10 लाख रुपए डाल रहे हैं in a mutual fund, we are not paying 10 lakhs plus some other part as expenses, right? We may have been doing that at one point of time, but we're not doing it currently today in 2022. So how does then a mutual fund charge us this expense ratio? How does a mutual fund charge us some money? And over here again, my apologies if you all will not, are you all able to see the screen? I hope you all are able to see the screen, but I'll talk you through it because some of these slides may the font is a little small, or YouTube may sometimes it gets a little smudged. So I hope you're able to see it. Over here, what we are saying is I've taken the example of a fund called HDFC Top 100 Fund. It's a very popular fund, large cap category में. All right. एक regular plan होता है और एक direct plan होता है. Regular plan में the expense ratio is 1.77%. Direct plan में it is 1.17%. It is lesser because जैसे मैंने बोला है, it is taking less expenses, right? The commission charges are not included. Now, the way this expense ratio is levied is a mutual fund charges you, the investor, for every day that you remain invested in the scheme. Okay, I'll repeat that. A mutual fund charges you, the investor, for every single day that you are invested in the scheme. How does it charge you every day? It deducts this 1.77 or 1.17 from the NAV before it publishes the NAV. So if NAV is published every day, तो पब्लिश होने से पहले वो अपना 1.77 रेगुलर प्लान से एंड 1.17 डायरेक्ट प्लान से निकाल के फिर जाके पब्लिश करते हैं. Okay, so what you will see over here is on Jan 1st, 2013, the NAV of a regular plan and direct plan is exactly the same. All right, it's exactly the same. But if you forward it to March 2022, you will see that the NAV of the direct plan is higher than the NAV of a regular plan. Why, you ask? Because you are subtracting less expenses. Because आप कम minus कर रहे हो, right? Think about it from this perspective. You've got two funds, you've got the same NAV, you've got a regular plan, you've got a direct plan. Both are the NAVs are 100 on day one. On the next day, from regular plan, let's say you are minusing 2 rupees as expenses, so the price becomes 98. Direct plan, you are minusing only 1 rupee as expenses, the price is 99. So फर्क हो गया ना. The direct plan ka NAV has become higher than the regular plan ka NAV, and this is something that will consistently go because you are always minusing lesser from the direct plan than you are from the regular plan. That is why the NAV is higher. That is why the returns are more. Is that clear for you? Just tell me if it's clear for you or not. I'll take another example. अगेन आदित्य बिरला फ्रंटलाइन इक्विटी फंड आप देख रहे हो कि लार्ज कैप स्पेस में रेगुलर डायरेक्ट एक्सपेंस रेशियो इज अगेन अराउंड 1.7 फॉर रेगुलर प्लान, इट्स ओनली अराउंड 1% फॉर डायरेक्ट प्लान. तो वापस हम लोग देख रहे हैं कि एनएवी इज 100.24. इट इज द सेम ऑन 1st Jan 2013, which was the day these were launched. But in March 2022, the NAV of direct plan is much higher than the regular plan, and therefore आपका returns also is higher by around 0.8 to 1%. Okay. Now, here's where it gets a little interesting. And when it gets a little interesting, I told you because of those recategorization and reclassification initiatives जो हम लोग देख रहे in the large cap space at least, we said there is very little differentiation between Nifty 50, Nifty 100 and any of the active funds because all of them are holding pretty much the same stock. All right. So what I'm saying is it becomes very hard to pick a winner in advance. Do you agree with me? It becomes very hard to pick a winner in advance because you don't know. सबके पास same types of portfolio ही लग रहे हैं दिख रहे हैं. So how do we know which one is going to be better? What I've done over here is I've taken out the expense ratio of index funds for you. These are two popular index funds, the HDFC Nifty 50 and the Axis Top 100. And I want to bring your attention to the expense ratio of their direct plans. और यहाँ जब आप देखोगे, you're seeing the expense ratio is only 15 paisa and 20 paisa. Isn't that a big difference? Right? Regular plan में you are paying 1.7% expense. Direct plan में you are paying 1.1% expense. यहाँ direct plan of index fund में आप दे रहे हो 15 पैसा 20 पैसा. इसका ये मतलब है that again I'm going here. So again, if you've got regular plan 100 say you're minusing 2 rupees, direct plan say you're minusing 1 rupee. Now regular and direct plan of the same portfolio, always direct plan is going to give you more returns than the regular plan because the portfolio is the same. But then you've got an index fund which is having the similar kind of portfolio, but you are minusing barely any expenses at all. तो मतलब ये लार्ज कैप एक्टिव मैनेज फंड जो है उसको ज्यादा परफॉर्म करना पड़ेगा टू मेक अप द डिफरेंस ऑफ एक्सपेंसेस. You get what I'm saying? It has to perform much harder to make up the difference of its expenses. So the question now that is running through my mind, and maybe आपके दिमाग में भी ये चल रहा है कि फिर ये large cap space में मतलब index fund is the better bet, no? फिर index fund नहीं करे because portfolio अगर same है, यहाँ expenses are much lesser. Regular plan to direct plan, the swing is almost a percentage and a half. That's a lot of money. It's a lot of money. But then there is other people also. Other people are saying, hey, yaar, Kushal, I want to go and see that, I don't mind paying more expenses. I don't mind paying more expenses because active fund ka job hai to beat the benchmark. So if you are going to beat the benchmark, then I don't mind paying the expenses. No, मेरे को तो पैसों से फर्क पड़ी है. I to care only about the returns at the end of it. Does that make sense? So we're already at 12:35. I'm going to take maybe around 10 minutes more. So this is going to be from 45 minutes. It's going to be close to around 55 minutes ka presentation. I hope you're okay with that. If you are okay with that, give me a thumbs up over here and click like or subscribe to this particular channel so we can be in touch and give me some feedback whether this is going well for you. Okay. Now, what am I going to do further? So we are saying we don't mind looking at active funds still if the performance is better. So the question now comes is how has the performance been? And I've gone and taken out some performance data for you. Ye performance data mein we are seeing over the last 3 years, 5 years and 10 years, how many large cap funds have been able to beat their benchmark? Isn't that what we want to see next? How many large cap funds have been able to beat their benchmark? And this is the data, right? What is in orange? You are saying, I'll read out the numbers to you. Only the orange slice, those many funds have been able to go and beat the benchmark. So, agar aap last 5 years ka data dekh lo, and this is as of December 2021, only 18% of all the large cap active funds have been able to beat the benchmark. 80% of the time, the benchmark is winning. Doesn't it make more sense in the active space to go and put our money in the benchmark instead of an active managed fund? मैं ये नहीं बोल रहा हूँ कि this trend will continue in the future. Everyone goes ups, everyone goes downs, but this is the part where you are actually going and saying, yeah, only 18% of the funds have beaten the benchmark. How are you going to select which those 18% of funds are going to be? So the percentage play, the probability play is to go and maybe say, hey, let's go and invest in the benchmark itself. This is in the large cap space. Mid cap, small cap space में भी ऐसा चल रहा है क्या? I went and took out that data also. And as you can see over here, यहाँ तो अभी ज़्यादा 50-50 लग रहा है. Right? It's more of 50-50. So there are a number of funds that are actively going and beating the benchmark because maybe the universe is more, maybe the opportunity is more. Large cap is only the top 100 companies, no? So everyone's going and having those same, because 100 companies में everyone wants to have the largest, no? लार्ज कैप फंड में रिलायंस तो चाहिए आपको, इन्फोसिस तो चाहिए आपको, एचडीएफसी तो चाहिए आपको. Those are the main big boys as they call it. But mid cap, small cap, mein, there is a lot of role for the fund manager to go and do it. And still, it's around 50% of the funds that are beating the benchmark. And people have seen a rise. People have seen a rise in passive investing, not just of EPFO, which has gone and started investing in ETFs and index funds, but even the retail investor is saying, yeah, maybe in the large cap sense, it makes sense to start focusing on costs and keeping our costs down, and we will be very happy with the market returns. Anyways, ऐसे लग रहा है कि market returns are beating the active funds 80% of the time or 70% of the time also. So maybe that is the way to go and do it. Okay. Now, what I went and did is I've also taken out some data to say, ठीक है, ये तो इंडिया में चल रहा है, हाँ, ये तो इंडिया में चल रहा है, यूएसए में क्या चल रहा है? Because USA at the end is USA, right? I mean, people look over there to see what is happening and take cues. USA markets also have been around since very, very much longer. So generally, it is a trend setter, right, as far as markets are concerned. And I went and took out the data of the percentage of US equity funds. So same format may, but here I'm not just talking large cap, mid cap, small cap, flexi cap. जो भी actively managed funds है, have they gone and how do they perform against the benchmark? Or agar aap, any one of you all are wondering over here, kaun invest karta hai for 15 years, 20 years plus, etc. Well, everybody does. If you haven't, come and attend the program on taking the first step to building wealth. That is one of the other webinars that I run in this Market Master series. The way to find out details about that is, again, just click a like and subscribe to these channels and then go and do it. All right. 15 years, 20 years ka data, what has it shown in the US? And I'm sure you will be very surprised by this. You will be shocked by this. Tell me if you're shocked or not. I'm looking at the center. I'm looking at the last 15 years data. You are saying in the last 15 years, only 14% of actively managed funds have been able to beat the benchmark. Or agar aap 20 saal ka data dekho, only 10% of funds have been able to go and beat the benchmark. Is that surprising? Only 10 to 15% of all US equity funds have been able to beat their benchmark. And as a result of which, and you're seeing this graph on the right hand side, what is in orange, and that is the ratio of passive funds. Blue is active funds, right? The ratio of orange you can see is going higher and higher. In 2010, it was 20%. जहां अपना आज 10% से थोड़ा ऊपर है. 2019 from 20 it became 40%, and it is suggested from 2025 that you are going to go and create that passive is actually going to become more than the active space. Is that interesting data? Give me a thumbs up if you think that this is interesting data. थोड़ी investing, ज़्यादा मस्ती. You are not shocked? आप तो बहुत तेज आदमी हो, हैं? Very good, right? Yeah, it does, right? It does seem that the underperformance is much higher in the developed market. So it's something for us to keep our eye on. But what I've gone and done is I've gone and taken out one study, because the question that I am asking myself is, why is it the case? Why is it that this underperformance is much higher than it seems? Is it just cost? कि passive funds के cost low है, therefore active funds are finding it harder to become, or can there be another trick to this entire thing? And I found one study which I wanted to share with all of you. I thought that if you all have interest, you all will find this very, very interesting. And this is a study on the S&P 500 done by Craig Lazara. They said they wanted to know, they took 20 years data, okay, from 99 to 2019, and they wanted to know that S&P 500, which is 500 companies ka index in the US, how many companies actually contributed to the rise and the growth of the S&P. Does that make sense what I just said? They looked at the S&P 500 index and said, ye S&P 500 index mein how many companies contributed to the growth of the index? Is everybody contributing equally? Are fewer companies contributing more than the other companies, right? The cumulative returns of 1012 stocks, because kya hota hai, over these 20 years, the composition of the S&P has also changed, right? The composition of the S&P has also changed. So some companies leave the index, new companies enter the index. So totally over these 20 years, S&P 500 mein, there were just above 1000 stocks. Okay, does that make sense? Then give me a thumbs up. Yeah, you all ask your questions a little bit at the end only, na? Until then, focus on what I am talking about. ये थोड़ा visualize कोशिश करने दो, because this is really, really interesting. मैं questions answer कर लूँगा ना. What is the problem with that? Okay. And this is some data that they've taken out. From this data that they've taken out, what are we seeing? That the average returns, the average S&P return over this period has been 6.3%. कैगर ऑफ 6.3%. आप सोच रहे होंगे वो थोड़ा कम नहीं है. एक आपको चीज रियलाइज करना है that A तो inflation in the USA is also very very less, but if you had taken another 2 years to this data, maybe you would have got close to around 10% return. Okay, so let's come back here. We are saying that the average return of the S&P index is around 6.3%. The median returns का मतलब क्या है? मतलब out of these 1,000 companies that were part of this study, median return is the halfway mark. So 50 companies have given returns on the left side of this arrow of the median, and 50 companies have given returns on the right hand side of the arrow. On the left hand side of the arrow, अगर आप देखो, it is 0 to minus 50, 0 to 50%, 0 to minus 50%. Basically, what they're saying is 50% of the companies were duds. 50% of the companies have, in fact, not contributed to any growth. They've contributed to losses of the S&P 500. Half the companies have been loss making in the S&P 500. Forget about contributing to growth, right? And only is very skewed the returns. Very skewed the returns. Only 26% of the stocks have outperformed the average. Matlab, historically, what they are trying to say, as far as their study is concerned, that fewer companies have contributed to the growth of the index. Zyadatar company dud hai. Most of the companies have actually given losses or have died. Very few companies have contributed to the growth. Now, what does it mean for us? Does it mean that it's very hard to beat the index? So what I've done is I've created this again, this little scenario. समझो कि सिर्फ 5 ही कंपनी है दुनिया में, okay, ABCD, and assume जैसे हमने देखा था कि the returns are skewed, right? That fewer companies are contributing more to the return of the index. Most of them are giving average returns or below average returns. So, is example में we said one company is giving 50% returns, the other companies have all given 10% returns. तो अगर आपको पोर्टफोलियो बनाना है, अगर आप फंड मैनेजर हो और अगर आपको पोर्टफोलियो बनाना है, and let's assume you can make one stock portfolios or two stock portfolios, मतलब one stock portfolio आपके कितने बनेंगे? 5 ही बनेंगे, A B C D E. और अगर आपको दो का कॉम्बिनेशन अगर करना है तो देन कितने 10 पोर्टफोलियो होंगे, just as I've created over here. Now, if you have all 5 portfolios in your company, this is called market return or index return is around 18%. Okay, but if we are going and actively trying to construct a portfolio, then we are seeing a little difference. In one stock portfolios, अगर आपके पास stock A है तो 50% तो आपका बनता है, you have gone and beaten the market. But if you don't have stock A in your portfolio, मतलब you have underperformed the market. Similarly, when it comes to two stock portfolios, अगर आपको वो winning stock है, then you have gone and beaten the market. But if you don't have that winning stock, then you have underperformed in the market. So when people at what we're trying to get at over here is, apart from cost, is there something more in the design of active and passive funds? Of course, on the assumption that we are making that returns tend to be skewed. When I say returns tend to be skewed, I mean fewer companies seem to be contributing to the growth of the market. Most of the companies are duds. तो अगर आप एक्टिवली मैनेज कर रहे हो, अगर आप स्टॉक्स को पिक एंड चूज कर रहे हो, and you don't have those winning stocks as part of your portfolio, or you are underweight on those winning stocks, it might be a little harder for you to beat the index in that case. Okay, this is just thought provoking. This is just something that is out there. I don't know if this will happen in the future, लेकिन एक नजर तो अपने को रखनी पड़ेगी. I'm coming to the end of this presentation, and we've got only a couple of slides left. And we're saying that in India, Nifty 50 has been leading this passive charge. Everything that I have told you, people have been waking up, and the Nifty 50 AUM, or at least for funds that are tracking the Nifty 50, matlab index fund plus ETF both, is over 2 lakh crores now. Total industry is around 35 lakh crores, equity plus debt. Or ETF growth last 5 साल में ते धनाधन भगा रहा है. In 2017, the ETF and index market, the passive market, was 50,000 crores. Now it is over 5 lakh crores. And you don't even have index funds and ETFs, but even international funds that are going and tracking the market. So this space is going to get hotter and hotter and hotter going forward. The question I asked in the beginning was, have passive funds, or should passive funds occupy core part of your portfolio or a part of your core portfolio? And the answer in my head is a certain yes. Okay, it's as simple as replacing. If I what I've done is I have replaced some large cap funds with index funds. Okay, I don't think you need to have more than five or six index funds or five or six equity funds as part of your portfolio. But certainly, generally, the trend is that most people have had only active funds before. Now there is certainly a case for saying at least a Nifty 50 fund, if not anything more, or a Nifty 100 fund for somebody who's a little bit more suave, for somebody who's a little bit more knowledgeable, who wants to be a little bit more aggressive. A Nifty 50 fund, Nifty Next 50 fund rather, becomes a very good option as well. But a simple Nifty index fund goes and does the job. All right. Um, Hit a like and be sure, in case you want to be in case you like this sort of style of presentation. I know it's a little different style, it's very free flowing, but if you like this style of presentation, one of the other things in Market Master, we have a 1.5 hour module on how to become a better do it yourself investor, where we go through various steps. And active versus passive investing, whatever we've gone through today, is a part of that particular program. Okay, so in case you want to have one goal, in case you want to have multiple goals, what is the bucketing approach, how you should put down your goals, then you decide the fund categories, the fitment should be correct. फिर आपको लेना है एक्टिव वर्सेस पैसिव इन्वेस्टिंग, शुड यू हैव एक्टिव फंड्स और पैसिव फंड्स एज पार्ट ऑफ योर पोर्टफोलियो. अच्छा, एक बार वो डिसाइड हो गया, हाउ डू यू सिलेक्ट द म्यूचुअल फंड स्कीम, वो भी तो इज देयर एज द नेक्स्ट स्टेप. अच्छा, अभी स्कीम्स भी सिलेक्ट हो गई. नाउ अगर आपको सोचना है कि मैं लमसम इन्वेस्टर हूँ, मैं एसआईपी इन्वेस्टर हूँ, हाउ मच यू शुड इन्वेस्ट to be able to go and achieve your goals. How do you adjust a goal for inflation? And finally, what is the ongoing review and maintenance that you have to do, right? That is something that we look at as well. So Market Master is actually a set of 3 webinars. The first webinar is taking your first step. It's a motivating webinar. It is for people who are saying, you know, we've never invested before, or if you are recent investors, एक दो तीन साल से आप लोग invest करते आए हैं, then that is a very very powerful program which you all can sit and sign up for. And again, it just gives you certain fundamentals and makes your fundamentals so strong, no? और हम लोग ऐसे ही बात करते रहते हैं. The second one is becoming a do-it-yourself investor, which is if you want to do goal-based investing, how you should go and set up your portfolio. And third, we talk about the disciplined investor, the role of discipline, the role of asset allocation. And that's another fascinating program. All these programs typically are around, sometimes we run it as 1.5 hour programs, sometimes we go and run it as 45-minute programs. So if you want to be a little bit more aware of these particular things, then hit a like, and I guess we will reach out to you on YouTube or however else with details of those particular